Hi, it's Brooks and Christopher Marr with MMG Real Estate Advisors, here to bring you the July 2024 Housing Market Report. The real estate market in 2024 is significantly different from last year. There are more for sale signs, an increase in open houses, and homes are staying on the market longer. This shift highlights changing dynamics in our local market, influenced by broader economic trends and the evolving preferences of both buyers and sellers. The current active inventory here in Orange County sits at 3,052 homes, its highest level since December of 2022, up only 4 homes from 2 weeks ago. So is this the inventory peak for Orange County? Only time will tell. Typically a peak is reached between mid-July and late August as kids return to school. This year, inventory has grown more rapidly compared to 2023 because more homeowners are deciding to sell. With demand levels similar to last year, the increase in homeowners listing their properties is creating a much needed boost in available homes in a market that is hungry for some more options. Now, talking about demand, the current demand here in Orange County increased from 1,615 to 1,624 in the past couple of weeks, up 9 pending sales. In Orange County, demand has closely mirrored last year's levels and will likely continue to do so as long as mortgage rates stay above 7%. Since the Federal Reserve began tackling inflation in 2022, rates have remained high. Rates will remain elevated as the Fed sees a more sustained downshift in inflation, decreasing any threats to the economy. May and June inflation readings are encouraging, showing a downward trend after a slight rise earlier this year. Additionally, various economic indicators suggest the onset of an economic slowdown in the US. Now, these factors are expected to lead to eventual interest rate cuts, maybe as early as September. When this happens, demand is expected to increase, with lower mortgage rates expanding affordability. As Christopher and I have said many times, this is tricky because if inventory doesn't increase to better meet demand, it could further impact affordability. Now, with supply remaining steady and demand increasing slightly, the expected market time, the number of days it takes to sell all listings in Orange County at the current buying pace, decreased from 57 to just 56 days over the past couple weeks, just 1 day. Last year, the expected market time was 44 days, indicating a faster market than today. Now, in the past couple of weeks, the luxury inventory of homes priced above $2 million increased from 1,119 to 1,130 homes, an increase of 11 homes or 1%, marking the highest level since November of 2019. Luxury demand rose by 8 pending sales, a 4% increase, bringing the total to 230. With demand rising faster than supply, the expected market time for luxury homes priced above $2 million decreased from 151 to 147 days. Now, however, at 147 days, the luxury market is far from instantaneous, necessitating a careful approach to pricing, given that it may take much longer to achieve a successful sale. So our advice to sellers, get your pricing right by analyzing recent comparables and pending sales data. Consider the condition, location, and upgrades of your home. Remember that overpricing will attract fewer buyers and offers, ultimately leading to lower net proceeds. And work with an agent that follows the data and current movement of your market. What's our advice to buyers? Despite the higher interest rates, there's an opportunity in negotiating on the homes that have been sitting on the market. But note that well-priced, upgraded homes in good condition are still flying off the shelves with multiple offers, sometimes above asking price. So those need to be approached a little differently. Now I'm gonna pass it to Christopher to go over some more key data.
Brooks and I receive a number of emails from people asking us about the accuracy of social media posts regarding real estate. Keep in mind, many of these posts are written as clickbait and rarely provide all the details. Kind of like those conversations with a child where key details are omitted. The difference is, these are written by adult children. Doom and gloomers were quick to report single-family home loans held by Freddie Mac and Fannie Mae were seriously delinquent for April 2024. But what does that really mean? A seriously delinquent loan reflects a loan that is 3 months past due or is in foreclosure. Freddie Mac reported 0.051%, while Fannie Mae reported 0.048%. Not surprisingly, they neglected to report that year over year, they were down from May of 2023, respectively 0.058% and 0.056%. These are below pre-pandemic lows for both, and the lowest level since 2002 for Fannie Mae. We must all understand that foreclosure activity will always be part of the market, but to what degree will determine the level of concern. We unpack the data with relevant context like the following to provide more clarity. For instance, delinquency rates by loan vintage. For Fannie Mae, 2004 or earlier, 1% of their portfolio. 1.42% down from 1.47%. 2005 to 2008, again 1% of their portfolio. 2.06 down from 2.13. Now 2009 through 2023, this is 98% of their portfolio, and it's 0.42% down from 0.43%. Another interesting statistic. In February 2010, Freddie Mac peaked at 4.20%, and Fannie Mae peaked at 5.59%. Obviously, a much different picture than social media posts or headline would suggest. To better advise our clients, we dive deeper into the data than most because of the dynamic nature of the housing market and the need for continuous observation, especially as economic conditions evolve. And there it is, your detailed update on Orange County's real estate market trends for July 2024. Monitoring these statistics and changes is essential for making well-informed decisions. If you find this video useful, please remember to like, share, and subscribe for more updates. Until our next update, feel free to reach out to us with any questions you may have.